Alright guys, welcome to another video. This is part 3 of the YouTube free day trading course. Just a brief recap guys, we've covered a lot of different things so far. We covered NQ, we covered the stock market, what futures contracts are, we covered the fair value gap, we covered liquidity, we've covered the Asia and London session, and right now I'm going to teach you guys about something called the inverse fair value gap. Now, I taught you guys liquidity already. We talked about how when the market sweeps liquidity to the upside, it ends up reversing, and vice versa. When it sweeps liquidity to the downside, it ends up reversing back to the upside. And I also talked about how after sweeping liquidity to the downside, we use fair value gaps to continue higher. I also talked about how after we sweep liquidity to the upside, like we do right here, we end up using fair value gaps to go lower. So I've explained bullish and bearish fair value gaps. Now we're going to talk about the inverse fair value gap, which is my main model and how I use it to get optimal entries in the markets and make the most profits. So, all right guys, so as always, we're going to go over some examples of this inverse fair value gap that I'm talking about. But let's go ahead and start off by labeling the highest high and the lowest low in our charts. You can pause the video now if you want to do it yourself. All right, guys, if you were able to guess this high and this low, you were correct. So as always, guys, if the sell side or low gets swept first, where are we looking for? We're looking to target the high. The algorithm likes to go from sell side to buy side. And vice versa. If we sweep this high first, where are we looking to target? We're looking to target the sell side liquidity because the algorithm likes to move from buy side to sell side. So let's move the market forward and see which liquidity gets swept first. All right, guys, so as you can see here, what gets swept first? The sell side liquidity. So I am going to look for a setup to target this high. Now, what have I taught you guys so far? We understand liquidity and we understand that fair value gaps are used as a bearish signal. If we're bearish in the market, all the bearish fair value gaps should be used to bring us lower. You guys can see that this bearish fair value gap was traded into right here, and we use it as resistance to bring the market lower. Then again, guys, right here, a bearish fair value gap, we trade into it and we use it to go lower. And once again, guys, this is another bearish fair value gap. What do you think is going to happen when this gets touched? We're probably going to go lower. And as you can see, we do reject. So this is the basic fair value gap. I've taught you guys this from the previous video. And this is where the secret sauce comes into play, guys. Do not miss this part. This is called the inverse fair value gap. I'm going to explain it to you right now. So now that we've labeled all these fair value gaps, let's see if you guys can find the bearish fair value gap that has formed right here. If you guys labeled this fair value gap, you are correct. So what do you guys think is going to happen when we trade into this fair value gap? We should use it as resistance to go lower, right? But what do you think will happen if we end up closing above the fair value gap? Let's move the market forward and see what happens. So all of a sudden, guys, instead of using this fair value gap to go lower, the market is revealing a very interesting hint to us that not a lot of people notice. If we end up closing above a bearish fair value gap, like you see on this candle right here, the body of the candle closes above the fair value gap. That is the secret hint called the inverse fair value gap. So I'm now going to label this as an inverse fair value gap in a chart. Why do I call it an inverse? Well, a regular fair value gap should be used as resistance to go down, right, in a bearish market. But if we end up closing above a bearish fair value gap, this becomes an inverse fair value gap. And in my eyes now, I'm looking for the market, again, to come up to the next area of liquidity, which is this green line that we see right here from this buy side right here. It's like the market revealing its hand to you. So now that this has happened, guys, the algorithms in my view have changed. And I am looking at the next obvious highs in the market as potential areas for the market to stop out traders. So this high right here, and then of course the high that I talked about earlier. Everybody who has been short the market and has been making money now has their stop loss above this high, and above this high. So the algorithms know that because they're obvious highs in the market, and I think that the market is going to target these highs to stop out all the traders and make sure everybody loses money. So this is my signal to enter long, and I'm going to target this high, and this high. I'll leave the take profit up here for the sake of the video. Where is the stop loss? How do I manage risk on this trade? I know to stop out the trade, and I know that the trade won't work if the candle closes back below the fair value gap with a body. If we wick below the inverse fair value gap, it doesn't matter to me. But if a body of a candle closes below, I will close the trade out for a small loss with a potential to make much more money. In this case, this is an 8-to-1, almost a 9-to-1 risk to reward, meaning I'm risking only about $1 to make $9 on this trade. So let's move the market forward and see what happens. You can see here, guys, that we did wick below the fair value gap, but we never closed below. So the trade is still valid. And now we start to come up. We are tapping into the inverse fair value gap again, a third time, a fourth time. But if you notice, guys, we only wick into the fair value gap. We never actually have a body close below it. And then look what happens after this, guys. The market's algorithm kicks in and the market cleanly delivers all the way up to all 3 take profits in the market. Now, I know this is probably confusing to you guys, but don't worry, we're gonna go over plenty of examples here. Don't get too confused, and let's move on to the next one. All right, guys, so here's another example of the inverse fair value gap. As always, guys, let's go ahead and label the highest high and the lowest low on our charts. Pause the video if you want to do it yourself. So guys, as always, if you guessed this high and this low, you are correct. If the market is bearish, guys, if we sweep this liquidity first, where do you think the market's going to go? I would expect us to go up. And again, if we sweep the buy side liquidity first, where do you expect the market to go? I expect it to go down. So let's move the market forward and see which one gets swept first. And boom, guys, here is the liquidity sweep. The sell side or low gets swept first. So as always, guys, I've taught you that bearish fair value gaps typically are used to the downside. You can see that we're making lower highs and lower lows. This little bearish fair value gap was used to go down. And of course, this bearish fair value gap was also used as resistance to go down. So now I'm going to delete those off the chart, and let's see if you can find the most obvious bearish fair value gap that was created when this low was swept. All right, guys, if you guessed this bearish fair value gap, you are correct. So what do we expect to happen with a bearish fair value gap? As always, normally they should be used as resistance to go lower. But what do you think is going to happen if we close above the fair value gap? That's correct, guys. This is going to turn into an inverse fair value gap. And in theory, we should be able to use this to go up to buy side liquidity. So let's move the market forward a little bit. So far it is being used as resistance. But all of a sudden, guys, look at this interesting green candle that forms in the markets. Right here, guys, the body of this candle closes above the bearish fair value gap. So this is the algorithm revealing its hand to me. And immediately I changed this from a regular fair value gap to a iFVG or inverse fair value gap. We've inversed it to the upside. So now it is my opinion that this is going to be used to drive the markets all the way back up to buy side liquidity. So as always, guys, my stop loss will be a 1 minute close back below the inverse because we're on a 1 minute chart. I'm always going to use the time frame that I'm on where the fair value gap forms. In this case, it's on the 1 minute chart. So this becomes my 1 minute iFVG. So my entry is on this green candle. My stop loss is a 1 minute close back below with the body of the candle. I don't care about wicks, only the body. And if you guys move the market forward, you will see slowly but surely that we do end up delivering all the way up to the buy side. Again, we never trade below the fair value gap. You can see we touch into it and we could even wick into it. That's fine with me. I don't care. As long as the body holds the inverse fair value gap, then we should continue higher. And you guys can see slowly but surely we end up delivering all the way up to that green line. It's going to take a while because this is a 1 minute chart. But you can see, guys, slowly but surely we do end up closing all the way back up to the green line. I'm going to push this forward so you can see it. Slowly but surely, guys, we climb all the way up to that green buy side liquidity, just like so. So do you guys see how beautiful this entry model is? We get a really good entry on the trade. This is a 4-to-1 risk to reward, almost a 5-to-1. So I'm risking about $1 to make 5, and we cleanly deliver all the way up to buy side liquidity. So this, in my eyes, is called a buy program. So when the algorithm closes above a bearish fair value gap, in my eyes, the algorithm switches from bearish to bullish, and all of a sudden the inverse is our entry to deliver us higher. And you can also see, guys, talking about bullish fair value gaps, all the bullish fair value gaps in this market end up being respected for the most part. These bullish fair value gaps, we touch into them once, twice, we go higher. Then we have another set of fair value gaps here. We touch into them and we go higher. Another bullish fair value gap right here. We touch into it and we go higher, all the way until we complete the buy program in the algorithms, delivering us from sell side all the way to buy side. All right, guys, one more example on the long side using iFVGs, and then we'll go over the short side. But as always, guys, let's label the highest high and the lowest low in this market. Okay, guys, if you pick this high and this low, you are correct. So as always, if we sweep the low first, I believe that we are going higher. And if we sweep the high first, then I think we're going to sell side liquidity. So let's move the market forward and see which one gets swept first. All right, guys, so in this case, the low got swept first. And again, guys, like I've taught you before, every bearish fair value gap here is used to go to the downside. You can see that we use this one to make lower highs and lower lows. And now let's see if you can find the most obvious fair value gap that was just created once this low was swept. If you guys guessed this fair value gap, you are correct. So if we are bearish, what do you guys think will happen when this fair value gap gets touched like it is right now? Well, in theory, we should use this to continue lower. But what happens if we end up closing above the fair value gap, making it an inverse fair value gap? Well, if you guessed that we're going to use it as support to go higher, you are correct. So let's move the market forwards. And boom, right here, guys, this candle closes above the bearish fair value gap. So all of a sudden, in my eyes, the algorithm has changed in the markets, and I immediately look for the highs in the market that I think short traders are going to be stopped out from. I see this high, I see this high, I see this high, and I see the ultimate high up here. So this is my signal to enter the trade. My take profit will be all the way up at buy side liquidity. And my stop loss, as always, guys, is going to be a 1 minute close back below the fair value gap that has now turned into an inverse fair value gap. As you can see, I label it here in purple. So let's move the market forward slowly but surely. And you will see, guys, that we come in and touch the fair value gap, or the inverse fair value gap, but we never actually end up closing back below it. The only way I'm stopping out of this trade is if the body of a candle closes below the fair value gap. And you can see, guys, that we deliver cleanly all the way to buy side 1, then the second take profit, and then we end up going all the way up to the third and fourth take profit as well, just like that. And of course, guys, if you want to understand how fair value gaps work to the buy side, just like all the bearish fair value gaps were used as resistance when we were coming down, now the bullish fair value gaps are used as support to go higher. We trade into them and then we end up going higher. All right, guys, so we just covered all the examples of using iFVGs to the long side. Now let's do the exact opposite and see how we use iFVGs to the short side. Again, guys, as always, mark the highest high and the lowest low that you see in this chart. If you guys guessed this high and this low, you are correct. And as always, guys, what do I expect to see? If the high gets swept first, I'm looking to target the low. If the low gets swept first, I'm looking to target the high. So let's move the market forward and see which one gets swept first. All right, guys, so you can see here that the high got swept first. So what am I looking for? In theory, guys, I'm looking for the market to target sell side liquidity. You can see here that all the bullish fair value gaps are used as support to go higher. So now let's see if you can find the most obvious bullish fair value gap that was created once we took out this high right here. All right, guys, if you labeled this bullish fair value gap right here, you are correct. So in theory, guys, if we're going to continue higher, we should use this bullish fair value gap to go higher. But what happens if we end up closing below the fair value gap? If a bullish fair value gap gets disrespected, I now expect it to become an inverse fair value gap and be used as resistance to take out the liquidity to the downside, right? We swept our buy side liquidity. We expect the market to reverse. And now once we see a bullish fair value gap get disrespected and close below, that will be my signal to go short in this market to target this low. So let's move the market forward and wait until this bullish fair value gap gets disrespected. Wow, guys, what a surprise. Right here on this candle, the body of the candle closes below the fair value gap. So now we are taking a short. Our take profit will be all the way down at sell side liquidity. Everybody who's been long the market has their stop loss below this low, and this low. And of course, how do we manage this trade? Well, it's exactly the same as we talked about on the long side. First of all, let's change this into an iFVG. Like we talked about, when we close below it, it turns into an inverse fair value gap. My stop loss on this trade will be a 1 minute close back above the inverse fair value gap. As long as this holds, the trade is still valid. And if we move the market forward, guys, you will see we tap into the inverse fair value gap, but we never close back above it. And slowly we deliver all the way down. Look at this. Notice how the candle never closes above the inverse fair value gap. We just wick into it. Let me move the sell side liquidity forward so you can see it. And slowly, once again, guys, we tap into this again. I know this can be scary, but we never close back above it. And slowly we deliver all the way down to that sell side liquidity. Beautiful trade, an almost 8 to 1 RR trade, meaning you're risking $1 to make 8. Okay, guys, so here's another example. Let's go ahead, as always, to label our highest high and our lowest low on the charts. Pause the video if you want to do it yourself. If you guessed this high and this low, you are correct. And as always, if the high gets swept first, where are we targeting? We're looking for the lows to get swept, and vice versa. If the lows get swept first, where are we targeting? We're looking for the highs. So let's move the market forward and see which one gets swept first. All right, guys, so this high got swept first. So let's go ahead and see if we can find the bullish fair value gap that forms in this leg right next to this buy side liquidity. Okay, guys, if you guessed this bullish fair value gap right here, you are correct. In theory, guys, this should be used to deliver us higher. But as always, what happens if we close below the fair value gap? Well, that is my signal that the inverse fair value gap has been created and that we're going to use it to go down to the low or the sell side liquidity. So let's go ahead and move the market forward until we get the close below. And here it is, guys. The body closes below the fair value gap. This is my signal to enter the short. Stop loss, as always, is going to be a close back above the inverse fair value gap. In this case, this is the 1 minute chart. So it would be a 1 minute close back above the inverse fair value gap. And if we move the market forward, guys, you will see we never close back above the inverse. We tap into it, which is totally fine. And slowly, guys, once again, another tap back into it. Never closing back above it. Again, here's a wick. We never close above the inverse fair value gap. And we slowly deliver. Let me move the sell side forward. We slowly deliver all the way down to that sell side liquidity. Just like this. Keep going, keep going, keep going, keep going, keep going. And boom, there it is, guys. And as you can see, the algorithm has switched from a buy program to now a sell program, and every bearish fair value gap is used as resistance to go lower. Okay, guys, so that is it. I know this can be a little bit confusing. Originally, I covered liquidity and fair value gaps. Remember, bullish fair value gaps are used as support to go higher in the market. Bearish fair value gaps are used as resistance to go lower in the market. And now we've covered inverse fair value gaps, which is my entry model that I personally use. It allows you to get one of the best entries in the market. It basically allows you to understand what the market is doing. The market is essentially revealing its cards to you. If you were playing poker, it's revealing its hand before it actually does what it is going to do. I covered this in a way that was easy for you guys to understand. If you have any questions, please, guys, post them in the comments below. You can also follow me on X or on Instagram and DM me there. I'm happy to answer any questions for you guys. That is the end of episode 3. I appreciate your guys' time. Hope that you learned something from this video, and I'm excited for episode 4.